Hello there, I'm your host Leelaa Rao, welcoming you to your fortnightly program Invest Wisely, your ultimate gateway to safe and intelligent investing. Coming up in this session is what are some of the common mistakes investors make and how to avoid them. When you look at your closet, you sometimes see many things there that you ended up buying without a second thought and never ever use them. This is true of your investment portfolio as well. Let's look at some of the common errors we commit in investing and find ways to build a healthy portfolio. Following that, investment policy statement or your mandate for your financial advisor. Nothing happens perfectly without charting out a plan and overseeing it from time to time. Your financial goals are the same too. As an investor or a client, you need to make sure that your investment goals are met well in time and in the right manner, and an investment policy statement will help you get there. Let's see that together. And finally, in question time, it's a forum to discuss some interesting emails by viewers. What are some of the common investment mistakes we make and how to avoid them? How often have you bought a stock just because you heard that on a radio talk show while driving to work? Or you heard a friend brag about his profits from a stock investment in a cocktail party, and after coming home, you quickly logged on to your online brokerage account and placed a trade to buy that stock, having no clue what the company does or which industry it belongs to. Would you call both these acts as investing? Well, I would call it nothing but betting or gambling. First of all, you need to realize you have spent quite a lot of your valuable time and energy to make that hard-earned money. You must think several times before you buy something you have no clue what it means. So the first rule of thumb in investing is buy what you understand or know. One of the most legendary investors of our time, Warren Buffett, has often been heard to say, "I buy what I understand." It sounds so simple, but it means a lot. It may not be possible for a lay investor to understand and analyze all the investments he or she buys. Hence, the best route would be either engage a well-qualified professional to manage your assets or buy into well-diversified mutual funds and exchange-traded funds or ETFs. The second rule of thumb is never fall in love with an investment. This rule holds good for any asset class such as stocks, bonds, or even real estate. When you see something that you have purchased do well, you tend to fall in love with it. When the underlying fundamentals go bad for the investment, you are either unable to understand this or sometimes you do not want to accept this. It is not just enough to learn when to buy something, but also when to get out of an investment. So never fall in love with any investment. Your goal should be to maximize your wealth or assets with as minimum as risk as possible. The third thought for the day is look upon your assets as one big portfolio. I have heard clients come up and say, "I wish to start a separate portfolio just for saving to buy my dream house and another separate portfolio for my children's education apart from my retirement portfolio." They would want different investment strategies for each of these portfolios. Now, one must understand here that the assets for all these portfolios have come from one source of funds, that is yours. And hence, your investment goals and plans must be for your overall assets. Investor psychology recognizes this behavior as mental accounting. The fourth thought for the day is be realistic in your investment goals. Being realistic in your investment goals will help you in taking the right amount of risk you can tolerate. Quite often, you may be willing to take a lot of risk to reach an unrealistic investment goal, but would not be able to have the ability to do so. Here you will end up taking too much of risk and hence have the threat of losing your precious principal. Expecting our portfolios to do something other than what they are designed to do is a recipe for disaster. The fifth thought for the day is diversify. Often you tend to see an investor owning some 50% of his portfolio in one company's stock. This may be either because he works for that company and has a huge position in his portfolio by exercising stock options, or sometimes he deliberately accumulated the stock because he likes it. If the investor has a large position of a stock because he works for the company, he should slowly sell some of the position to diversify into another position or stock. If he intentionally bought into one stock and holds a large position, he should avoid prolonging such an error into the future and lighten his position. A thumb of rule guide is you must not hold more than 5 to 7% of your overall assets in a single stock or bond in your overall portfolio. The sixth thought for the day is don't wait to get even. Quite often, novice traders or investors end up with some losers in their portfolio. Instead of accepting their mistake of having chosen a loser, they tend to wait for the stock to break even. Behavioral finance calls this a cognitive error. This behavior is also because most people are loss averse, meaning they experience more pain from losses than pleasure from gains. This explains why investors hate to sell losers. By doing this, investors lose out in two ways. First of all, the loser in the portfolio may further slide down until it becomes absolutely worthless. And secondly, there is the opportunity cost of what may be a better use of those investment dollars if you have shifted elsewhere. The seventh thought for the day is don't trade or churn your portfolio. People think they make a lot of money by trading continuously. By trading actively, you make money for the brokerage firm and not for yourself in the long run. You tend to lose out both on brokerage fees and also on taxes quite often. The eighth thought for the day is never be overconfident. Overconfidence misguides people to be too sure of their opinion. This leads them to take over too much risk they can tolerate, or in some cases leads them to underestimate the risk factor in their choice of investments. The ninth thought of the day is don't act snake-bitten. In my practice, I hear people come and say, I lost a lot of money in the stock market and hence put my life savings in real estate. Behavioral finance calls this snake-bitten. You cannot point an accusing finger on the stock market or any other asset class for having lost money there sometime in the past. Look at it this way. The subprime O's have pushed real estate prices to rock bottom in many top cities of the world. Would you now say, I will stop investing in real estate? Remember, if you invest after careful analysis and research in any class of asset in the market, you will come out successful in the long term. You will lose only if you invest led by emotions. Now, this list can get very exhaustive. Since we are time bound here, we can turn our attention as to how we can avoid these mistakes. Most importantly, have an investment plan in place. If you are using a qualified investment professional, discuss your goals, your means, your preferences, so on and so forth with her. The best way to do this would be to have an investment policy statement in place. Okay. After we come back from the break, I'm going to discuss with you the facets of investment policy statement and how extremely important it is to meet your investment objectives both in the short and long term. Invest Wisely will be right back. Stay tuned.